Hello everyone, it's Davide here and welcome back to Learning Finance. In today's video guys, I want to talk about the stock market situation right now. The situation with the Treasury bill, basically the T-bill 10 years rate, and what is going on, inflation, hyperinflation, will we have hyperinflation? What can we expect? Okay, so will tech continue to sell off in the future? Will the stock market crash again, or will this shift through value stock actually last? So I'm gonna just explain my personal opinion, which obviously can be wrong, is just my opinion. Basically, I think that the main question here is the Fed losing control over the interest yield over there? I mean, has the Fed still the control of the 10 years Treasury bill? What is going on? Will it continue to rise or not? Should we be worried about it? Or maybe is a little bit too much exaggerated by media? Just want to tell you my opinion. The only thing I ask you is please leave me another like. It's very important and I thank you for it. And subscribe to the channel so you don't miss any new updates. Let's begin. Alright guys, so the treasury bond over there, as we can see the situation, basically if you follow my channel we have been following this obviously, and since the bottom of the pandemic it was at 0.4, now we are around 1.6, and in previous videos I have explained you why these could have an impact if it is uncontrolled over especially growth stocks. And that's basically what we have seen in the previous weeks with the Nasdaq going down. But I've also told you that this was basically the end of 1 year cycle according to cyclical analysis. And then this area that I've drawn you, it was a strong support, very strong support that could actually stop the price and end the cycle. Now, we have seen that this actually has happened, okay? We see that the price came exactly in the middle of that square and now bounced back. So is the cycle closed? Well, according to cyclical analysis, we could see still some weakness for March. However, I also told you that if the stock market was accelerating the downtrend over there, it could be that the cycle actually will close sooner. And that's probably what has happened. Anyway, we still have some days in front of us to see. Obviously, we talked also about the fact that value stocks with the rate going higher are obviously preferred by investors. We have seen a shift from growth tech stocks to basically value stocks, mainly investment funds and all this kind of stuff. We see that the Dow Jones is at all-time highs. Everything is going higher, right? So we have cruises, airlines, absolutely everything going higher. This is American Airlines, look at that. Anyway, what's the situation now? I mean, can this continue to grow without any control or not? Because interesting enough, on Wednesday, the 17th, we have a very important meeting from the Fed. The market will pay a lot of attention to it, especially because in March, it will going to end that kind of easing that the Fed gave to banks, okay, for banks' liquidity. And we don't know whether the Fed will, let's say, extend that easing in terms of liquidity or not. According to what they will say about it, we could see some turbulences in the short term, but that's fair enough. When we just type 10 years Treasury yield on Google, basically we see that all the articles are talking about that, how it seems to go higher without control. We don't know if the Fed is still in control of that. See no peace for markets, all this kind of stuff. But the situation is quite overwhelming. We don't know what to do. And in my opinion, when this is the case, the main problem is that we have too much information and the quality is very low. It's very low because their business works with clicks. So they don't give a damn about the quality of the information. All they care is to scare people so that, because fear is actually one of the best clickbait stuff that you can do. Okay, so if you do some fear articles, people will read those articles, but the reality is that we don't know what the hell is happening, because the information it just basically doesn't tell you anything. So what I like to do in those cases is just to look at the graphs. Okay, it's just something that people probably don't do. I don't know. Anyway, I like to do it because when you look at graphs long term, actually you can kind of have an idea on where the things are going. Okay, so what is really happening now in terms of daily basis, so short term view, we see that the yield just broke above 1.5 and now is maybe a little bit retracing at the 1.6 area over there, this resistance that we have right here. However, in order to better understand the things, let's shift to the monthly time frame, which in my opinion is more significant. Now, in this graph, as we can see, the trend since basically the 80s has always been a downtrend. A downtrend which came into this channel over there, downtrend channel, and it's almost incredible how precisely the yield basically stayed within this range, almost mathematically, okay? And obviously here it was around 9, and then you're going on always closer and closer to the zero level. And what we have seen over the past 15 years is that this downtrend has actually flattened a little bit, okay? Now let me delete some things so you can see clearly. As we can see, downtrend, 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 and here basically since 2010, 2011, you see how it flattened, okay? It went basically more flat around the 1.50 area. Look at how the 1.40, 1.50 area worked as a support since 2012, basically 1, 2, 3 times. Then we had here the breakdown of the pandemic. February, boom, went down. However, when we take a look at this long-term graph, what we realize is that since August 2011, the 10 years Treasury bond interest yield has always been somehow in this range between the 1.40, 1.50 area and the 2.50 over there. Look at this range, basically more than 10 years range, okay? Obviously we had a couple of occasions where the yield actually went near to 3. Here probably, if you remember, this is the case where the Fed actually put interest yields higher, and then everyone started to crash. It was basically 2018. Then they changed their minds and reduced the rate, and the rate came back into this range over there, and the market continued to go higher until the pandemic event, which is over there. After the bottom of the pandemic over here, we have seen the interest yield basically staying below 1 for the entire duration of the lockdown stuff, okay? So as far as the economy were closed, or at least as far as we didn't have a vaccine ready. But when we take a look at this graph, I mean, what is strange for you? Is this range here strange, or is this event over there strange? Because that's the main question, right? So is this pandemic event, pandemic drop over here strange, or is the fact that the rate is coming back to what I like to call a normal range something that is strange for you? Now, in my opinion, even though there are a lot of rumors and stuff, and basically everyone is saying that the world is gonna end tomorrow, but in my opinion, this is absolutely normal. What is strange, and I'm gonna write you over there, is not the fact that the rate is coming back to the range. What is strange is this yellow part, which is the pandemic event. Okay, something that hopefully we are not gonna see in the next 100 years. Okay, so that's the strange part. While, in my opinion, that basically green box over there is the normal range for the 10 years treasury bond. Okay, so what the market is doing now, the market has understood that probably in terms of lockdown and the economy being shut down, probably the worst has gone. Okay, so the market usually anticipates those moves because we know that in terms of unemployment, in terms of non-farm payrolls and all this kind of stuff, it is not a good situation yet. Okay, but the market is expecting that as you reopen everything, this curve will eventually continue to get lower and lower, closer to the pre-pandemic level. Okay, I'm not gonna say that they're gonna match those levels, but at least getting down more. As well as from this basically continue to go higher. So what's the answer to those expectations by the market? The bond market is to come back to a normal range. Here we had something incredible, something that no one was expecting, and now the market has just realized that probably the worst has gone and it's coming back to the normal range. Now, everyone is freaking out about this coming back to normal movement. In my opinion, that's absolutely normal. And that's why also Powell from the Federal Reserve basically didn't say much about this thing. Because what he has to say, I mean, do you want the interest yield near to zero all the times? It's not something impossible. Okay, now I know that there are some countries, like for example Germany, which they have their bond yield sometimes even below zero. But in the case of the United States, I think that they have a very great stock market, and if people start to see that basically the worst has gone, money will flow into stocks, okay, leaving bonds, because that happens when basically everyone is afraid of the situation and all the money, pensions fund, all this kind of stuff flows into bonds. So you buy bonds, the price goes higher, the rates goes lower. When the fear has gone, it happens the opposite. Okay, so maybe capitals flowing back to stocks, and that's what you are seeing, coming back. Now, inflation. But we have the risk of inflation, hyperinflation. Now, in my opinion, that's just my opinion. I always say, take a look at the velocity of money, M2 velocity. This is important. We have had a downside trend since the year 2000 on the velocity of money. Obviously, the quantity is a variable, but if you have this velocity always continuing to stay down, well, it's very unlikely to see hyperinflation. Now, obviously, in March, we are going to see a higher level of inflation for the year-to-year measure, because March of 2020 inflation was almost negative. So if you compare the 12 months, we are going to see a higher level. But as long as the interest yield and the situation remains stable in this range, which has lasted for 10 years, okay, more than 10 years now, I don't see nothing to actually be too much worried about, in my opinion, in terms of stocks. Obviously, in the short term, we could see some volatility, like, for example, we have seen a couple of weeks ago, especially with tech stocks. Where is the higher risk in these stocks? In my opinion, in all the companies that they don't make money yet. For example, one example is biotech, okay? This kind of DNA stocks, or even as I showed you the previous video, my most speculative one, which is VUZIX, okay? That's obviously a risk because the company right now is not making that exact amount of money. But if we see, for example, Google, Facebook, Amazon, Netflix, Nvidia, if we see fear in these stocks and basically you get cheap prices because people are freaking out just because the rate is coming back to normal, in my opinion, I will take all those opportunities if they come as a buy opportunity. Because as long as the rate, maybe as JP Morgan said, a little bit of inflation until 2022, and then coming back down a bit. But as long as the rate remains basically in this range, in my opinion, it's just normal. Okay, absolutely normal. So if you see the market, stock market freaking out, if that remains pretty stable going on, also remember always to take a look at the oil price. They could be all buy opportunities, because in my opinion, as long as things remain pretty stable, there is nothing to freak out. Now, what could be the problem? Obviously, if they lose control, is not now. Now they have a lot of time to think about that. You lose control if you have the yield, which basically in a short amount of time, it breaks above that level, okay? And you pass the 3 level. Now that will obviously be a problem, but that would be a problem also for value stocks, because all these companies, they have a lot of debt. So that would be a major problem for the entire stock market. But as of now, I don't think that there is too much to be worried about. So that's the end of the video. That's my opinion. I could be wrong. Just leave me down a comment with your opinion, and leave me a like, subscribe to the channel, and as always guys, have a wonderful day.